So who is the world's greatest investor? And more importantly, what can you and I learn from his or her strategy? In my opinion, the world's greatest investor is somebody that most of the public has never heard of. Many of us have heard of Peter Lynch or Warren Buffett, but Jim Simons, in my mind, is without a doubt head and shoulders above all the other names that we hear mentioned in the press. And the reason I say this is because he was the lead on the Medallion Fund, which delivered a 66% per year gross return over a 30-year period, which is a staggering number. To put that in perspective, if you invested $100 in the Medallion Fund at the beginning and 30 years later you had gotten that return, the gross return, you would have close to $400 million. That's just an absurd amount of money. So this story is not necessarily about Jim's journey and about Jim, but it's about his strategy and what we can all learn. I also want to share that Jim Simons, as I record this, recently passed away, which is one of the reasons that motivated me to make today's video. So a couple things about his strategy. First off, he was not a finance person. He was not an investment person until he turned 40. And then he decided he wanted to get into finance. He was a mathematics professor. And so one of the things we can learn is we all bring into investing our unique perspective that gives us an advantage in certain areas and can also be a handicap in others. So that's one of the things. The next thing I want to share is that even somebody of Simon's ilk, somebody as successful as Jim Simons, in multiple interviews, he talked about the need to control his emotional response to what was happening in the marketplace, right? It's just a knee-jerk reaction. For instance, there's an interview where a friend of his said that during COVID, he was very worried about the rapid decline, at the beginning of COVID, the rapid decline in the stock market, and thinking of going against the strategy that has worked for him for so long. And his friend said it was one day before the market had bottomed out, right? And so none of us are immune to the emotions, and particularly the fear aspect when things are scary out there. So if you feel scared, if you feel like you want to react to the market going down, if you feel like you can time the market, which I personally think is a fool's exercise, it's much more likely to hurt you than to help you. If you feel like you want to react, take solace in the fact that you're not alone. And the person that Azul thinks is the world's greatest investor had to fight those emotions as well. The second point is Simons would say that winning and getting returns like that is as much about risk control, it's as much about defense as it is about offense. And the strategy, the algorithm that the Medallion Fund, which is the fund that delivered these results, used, somebody described it and said, if a strategy was not working, or when market volatility surged, Renaissance's system tended to automatically reduce the positions and the risks. So rather than doubling down on ideas that might not be working, the algorithm, and Jim Simons had a PhD in mathematics. I mentioned he didn't get into the finance and investing industry until his 40s. But before that, he was a professor in mathematics. So a lot of what Renaissance did and did really, really well is come up with algorithms and look at what are the trends. Jim Simons would say that a big part of Renaissance's success is finding these patterns that were going to repeat themselves. And oftentimes, the people that were developing these algorithms did not know why these factors were important, but they were. And I want to bring it to something that's getting a lot of media attention right now, which is artificial intelligence. Basically, what Renaissance Technologies, was doing with the Medallion Fund was using algorithms to find trends and then to be able to profit on those trends. And they started off not in the stock market, but in the commodity market. So commodities like orange juice and steel and, just things of that nature, just, raw ore and oil. And they moved into the stock market to find a bigger marketplace where they had more opportunities. So if you look at artificial intelligence, and many of us, myself included, are just blown away at how well artificial intelligence can write. And essentially it's artificial intelligence like ChatGPT that many of us are working with now, or at least experimenting and playing with. That is a large language model. So it's taking a bunch of sentences, a bunch of well-written writings, and using it to predict what the next word should be in a phrase. So for instance, if you had let's say, Jack, and it would predict the next word is much more likely to be Jill than it is spoon, right? Jack and spoon. So the large language model like ChatGPT can predict the next word. What Simon's algorithm would do was predict what the next move was going to be in the stock market. Now, that's not something that you and I can do, but AI, artificial intelligence, is getting much more powerful. And I think there are tools out there coming that are going to help some people invest better. And it's also going to hurt other people. I'm not a fan of what I call black box investing, which frankly, in my opinion, is what Jim Simons was doing. They created an algorithm and they let this algorithm decide what the next investment should be. And I think for professionals, that's fine. But for mere mortals like you and I that don't have PhDs in mathematics, the challenge with an algorithm is, what are you going to do when it's down 20, 30%? And you have no idea why this algorithm isn't, tweaking things along the way. In fact, sometimes it might be saying to buy more. Now, it sounds like in Medallion's case, in Jim Simons' fund's case, it actually reduced that position. But with these black box investments, it can be hard because you can't look at the fundamentals to help you stay the course. Let me give you an example. During COVID, during the great financial crisis, if you had a company that had gone down in value, and during the great financial crisis, many companies, strong companies, good companies, that had nothing to do with finance, they were operating companies, they were Main Street America. These companies were down 30, 40, 50%. Well, if you could look at the company and say, okay, this is their business, they should not be affected long-term by what's happening. Short-term, yes, but they're good at what they do. They have a great management team. They're first in class. They have a good competitive position, particularly in the great financial crisis. They have a solid balance sheet. If you can look at the fundamentals of a company, it will give you comfort in the darkest days when it feels like, oh my goodness, I have to sell, right? Our emotions make us a forced seller when a position's down, and we just say, I can't stand the pain anymore. Well, there's two things that can help you withstand that pain. One is having cash so that you can meet your living expenses if you're in retirement, so you're not forced to sell in order to raise cash for your living expenses, but also cash that might allow you to buy a company that you've always admired, that you've always thought you'd like to own, but maybe it was too expensive. Well, now it's on sale. And you look at a market correction differently. when you don't have to sell something inexpensively to buy something that's inexpensive. If you have cash, cash is king in a situation like that. So one thing that keeps us from being a forced seller in a down market is having cash to fund our living expenses, to take advantage of opportunities. And the other thing is being able to look at the fundamentals and say, yes, this position's getting hurt, but the fundamentals are still there. And we are going to get past whatever the current crisis is. I mean, you look over the last 100 years, there's been 2 world wars, there's the Korean War, the Vietnam War, there was 9/11, there was the Cuban Missile Crisis, there were all kinds of scary things that happened. But eventually we work our way out of that crisis, even the pandemic. Eventually we work our way through that. And at that time, well-run companies that are selling a valuable product at a fair price, that are well-run, that are conservatively financed, almost always they can weather a storm like this. So that's, AI is coming. There's going to be AI tools, I think, for average everyday investors that are going to look a lot like what Jim Simons, or they're going to claim to look a lot like what Jim Simons' company did. But 30 years and delivering a 66% gross return per year is staggering. But even with a black box model like that, right? What are you going to do when it's down for the first time ever, where the returns are negative? I believe in that 30-year period, including the great financial crisis, they never had a down year. So when all of a sudden, if you do have a down year, you're going to be questioning that model. So AI is coming, but I'll say there's a difference between AI models and buyer beware. I want to put that on your radar screen. I also want to share that fees do matter. I've mentioned several times that if you put $100 in a fund that goes up by 66% a year over 30 years, that amounts to $400 million. But if you put Medallion's fee structure on top of it, which I understand was 5% per year, and they got 44% of all positive returns. When you put that fee structure on it, that same $100 still does really, really well, but I believe the returns were about 30%. So it went from 66% a year gross to about 30% net. And when I ran the numbers with the exact number, instead of $400 million gross, the net number is $2 million. So fees do matter, and probably never as dramatic as here. The other thing I said that this is not about Jim Simons' life, but I do want to share one thing, and that is, unfortunately and tragically, 2 of his sons passed away. One son was hit by a car, and another son died in a diving accident off the coast of Bali. And I mention this just thinking more holistically about life. None of us get through life unscathed. Jim, is as successful as he was professionally, Jim still spent time in the crucible of pain. And unfortunately, most of us are going to spend some time in that crucible of pain, and hopefully it doesn't last forever. But know that it's just part of the life experience. And I share that because it's about succeeding over the journey. And the journey is going to have twists and turns along the way. The journey is going to have potholes. The journey is going to have some pain. And the other thing is, Jim Simons retired in 2010. And as I record this in 2024, that means Jim Simons got about 15 years in retirement. And I've shared before that I think it's important that all of us are deliberate and conscious about when we decide to retire. And one of the things that I share is at 60 years old, most of us have less than 1,000 weeks of healthy active time in front of us. And that's not a lot of time. I'm not saying early retirement's for everybody, but I want you to make the choice that's right for you, because in Jim Simons' case, while he had this incredible fortune, he did get less than 1,000 weeks in retirement. And that's why I made this video up here, which talks about it's go time. If you're in your 50s and you're in your early 60s, this is your last chance to retire early. So watch that video, and thanks for watching this one. Bye-bye.